Okay, so we are doing exercise 8.7 on page 836. All right, 8.7 says, on December 31, 2021, when its allowance for doubtful accounts had a debit balance of $1,400, Dallas Company estimates that 9% of its accounts receivable balance of $90,000 will become uncollectible and records the necessary adjustment to allowance for doubtful accounts. On May 11, 2022, Dallas Company determined that B. Jared's account was uncollectible and wrote off $1,200. On June 12, 2022, Jared paid the amount previously written off. Instructions: prepare the journal entries on December 31, 2021, May 11, 2022, and June 12, 2022. So, okay, we're going to do the entry on December 31, 2021. On December 31, 2021, when its allowance for doubtful accounts had a debit balance of $1,400, Dallas Company estimated that 9% of its accounts receivable balance of $90,000 will become uncollectible and recorded the adjustment. So we're going to take the accounts receivable number of $90,000, right? Times 9% is what they told us, times 9%. That is going to give us $8,100. $8,100, okay? So that is what we want the ADA to be, $8,100. And the rule tells us, so they told us in this problem that the ADA had a debit balance, right, of $1,400, right? $1,400. So the rule tells us that if the ADA has a debit balance, we add the balance to what we want the ADA to be, right? So we're going to take $8,100 plus the debit balance of $1,400. That's going to give us an entry of $9,500. So our entry for the first one is $9,500. So we're going to December 31, 2021, we're going to debit bad debt expense, $9,500. And we are going to credit allowance for doubtful accounts, $9,500. Okay, so that's December 31. Okay, the next date on May 11th, 2022, Dallas Company determined that B. Jared's account was uncollectible and wrote off $1,200. So we're following the allowance method, and when we're following the allowance method and an account goes bad, what we do is, well, first we have the date. It is May 11th, 2022. We're going to debit allowance for doubtful accounts because we want to take that money out of there. We're not doubtful it's going to go bad anymore. It went bad. So we're going to debit that for $1,200. And then we're going to go in and we're actually going to credit the accounts receivable because we're not going to get this money. We're not doubtful it's going to be paid. It's not going to be paid. So we're writing it off. Okay. So we're crediting allowance for doubtful accounts, $1,200. All right. Now, oh, I put May 22nd. It's May 11th, not May 22nd. Okay, May 22nd. Okay. Now, on June 12th, it says, Jared paid the amount previously written off. So when an account is paid after it was already written off, you have to, 1, put it back, and then 2, post the payment, okay? So we've got June 12th, 2022. This is the put back. We're going to debit accounts receivable, $1,200. And we're going to credit allowance for doubtful accounts, $1,200, This is the putback, all right? We're then going to post the payment, all right? We have to post the payment. So we're going to debit cash, $1,200, and we're going to credit the accounts receivable for the amount of $1,200 because the customer paid the account off. Okay. Now I'm going to put next to here that this first one here was ADA had a debit balance, right? And you have to do all the math to figure that out. This here is a write-off with allowance method. This here is back, written off account. And this is the payment of the written off account. And generally, when you have a putback, you're going to have a payment. So these are always going to, these two entries are going to be done. The putback and the payment are going to be together. Okay. All right. And you will see that in your homework on the exam. You'll have some kind of a allowance method you're going to do. It's either going to have a debit balance or a credit balance, or it's going to have a zero balance. So you'll have something to do where you have to do an entry for the allowance. That's this one here. You're then going to have an account that goes bad that you're going to write off. You're then going to have one one of the ones you wrote off is going to be paid, so you're going to have to put it back, and then you're going to have to post the payment. You may also have one that is a direct write-off method, where you just directly write it off, where you debit bad debt expense and you credit accounts receivable, which is the incorrect way to do it, but you may have one of those as well. So you'll want to have that method written down as well. All right, I'm going to stop the recording there.